Hi class, welcome to Business 20, Introduction to Business. In today's lecture, we'll go over business ownership. Our learning objectives are examine the different forms of business ownership, explain how corporations are formed and how they operate, identify the questions to ask in choosing the appropriate form of ownership for a business, define mergers and acquisitions, and explain why companies are motivated to merge or acquire another company. Choosing the right business structure is crucial for any entrepreneur or business. Each form offers distinctive advantages and disadvantages impacting legal liability, taxation, and administrative requirements. Before you select what type of business ownership you prefer, ask yourself the following questions. 1. Do you want to minimize the cost of starting your business? Do you hope to avoid complex government regulations and reporting requirements? 2. How much control will you like? How much responsibility are you willing to share for running the business? What about sharing the profits? 3. Do you want to avoid special taxes? 4. Do you have all the skills needed to run the business? 5. Are you likely to get along with your co-owners over an extended period of time? 6. Is it important to you that the business survives you? 7. What are your financing needs and how do you plan to finance your company? 8. How much personal exposure to liability are you willing to accept? Do you feel uneasy about accepting personal liability for actions of fellow owners? So what are the forms of business ownerships that we'll be going over? The first one is sole proprietorship. We'll be going over partnership, C corporation, S corporation, and limited liability company, also known as LLC. In a sole proprietorship, you, the owner, have full control over your business. You make all key decisions and are typically accountable for managing daily operations. In return for taking on this responsibility, you receive all the income generated by the business. Sole proprietorship is one of the easiest forms of business ownership to set up. It requires minimum paperwork. You, as the owner, you have direct control of everything from the logo to the marketing to when you open or close and establishing your schedule. When forming a business under the sole proprietorship, you, the owner, you have unlimited liability, which means that you're responsible for all debts and liabilities of the business. This means if you get sued, there's a chance that they can go after everything you own, such as your house, your savings, or anything that's under your name. Some of the tax advantages are that the profits are taxed as personal income and reported on your tax return, meaning that the business is not subject to separate federal and state income taxes. You will need to file a Schedule C and a 1040. Partnerships. A partnership, also known as a general partnership, is a business jointly owned by 2 or more people. About 10% of U.S. business are partnerships. Establishing a partnership is more involved than setting up a sole proprietorship, but it remains relatively simple and cost-effective. The expenses depend on the business size and complexity. Although you can create a basic partnership without legal or accounting assistance, seeking professional advice is usually recommended to help address potential issues that could lead to partner disputes. To lessen these partners' disputes, you could create a partnership agreement. With a well-executed partnership agreement that specifies everyone's rights and responsibilities, there might be less problems in the future. The agreement can include the following: amount of cash and other contributions being made by each partner, What is the division of partnership income or loss? What are each partner's responsibility? Who does what for each department or part of the business? Under what conditions can a partner sell an interest in the company? What are the conditions for dissolving the partnership? And what conditions for settling disputes? Now, under a partnership, you have shared resources. This means that you have more capital available, you have more expertise and skills available, you have more hands on deck, and you have more network available to you. You also have more flexibility. Partnerships can be structured in various ways to accommodate different business needs and relationships. This means that you could have more time off, more time. You also make joint decisions in a partnership. So not all the decisions fall on you. You have someone else or a few other people to rely on when it comes to making a decision. Tax advantages. Some of the tax advantages are that partnerships are generally not taxed at the entity level, but income is passed through to the partners for individual taxation. And under partnership, this type of partnership, you have unlimited liability, like you did in sole proprietorship. So this means that general partners are typically personally liable for all debts and obligations of the partnership. Similar to sole proprietorship, this means that um, anybody suing you or any banks going after your debt, they could also go towards your personal finances, your house, and your cars. Before we dive into S corporation, also known as S corp, let's go over what corporation is. A corporation is a business entity established by filing articles of incorporation with the state. Its owners, known as shareholders, are distinct from the corporation itself, which operates as a separate legal entity. These separations protect shareholders from personal liability for the corporation steps, limiting their responsibility to the amount they have invested in the business. Corporations also have officers and directors who manage operations. Unlike other business structures, corporations must adhere to specific legal requirements and corporate formalities. So an S corp, they avoid the double taxation by allowing profits and losses to pass directly to shareholders. Personal tax returns. The corporation itself is not taxed at the corporate level. They also have limited shareholders. S corps are restricted to a maximum of 100 shareholders. Shareholders must be U.S. citizens or resident aliens. Foreign individuals or entities cannot be shareholders. When it comes to the profit distribution and reinvestments, direct pass-through, so profits and losses are distributed directly to shareholders based on their ownership percentage, regardless of whether the profits are distributed. Retaining earnings can still result in taxable income for shareholders, even if not distributed. So what about the formation and eligibility? To be treated as an S corp, the business must file a Form 2553 with the IRS, adhering to specific deadlines and eligibility criteria. They must meet all IRS requirements, including the limitations of the number and type of shareholders and classes of stock. C corporations, also known as C corps. So when it comes to taxation, C corps are subject to double taxation. This means the corporation pays taxes on its profits at the corporate tax rate. When dividends are distributed to shareholders, those dividends are taxed again at the individual rates. Corporate profits are taxed separately from shareholders' personal income, which can be an advantage for retaining earnings within the company. Now, forms of ownership, C corps can have an unlimited number of shareholders, making it easier to raise capital. They can also have foreign shareholders, which is beneficial for businesses seeking international investments. C corps can issue multiple classes of stocks, such as the common and preferred, providing flexibility in attracting investors. When it comes to profit distribution and reinvestment, C corps can retain earnings within the company for reinvestment without passing them through the shareholders immediately. Profits that distribute as dividends are subject to taxation at both corporate and individual levels. Now, when it comes to formation and eligibility, when a business incorporates without selecting C Corp status, it is automatically treated as a C Corp. There's no restrictions on eligibility, which is generally easier to qualify as C Corp with the fewer restrictions in ownership and stock structure. Limited liability company, also known as LLC, provides the attractive features of the three common forms of organization, such as corporation, sole proprietorship, and partnership, and avoids the unattractive features of these three organization forms. This form of business ownership provides business owners with limited liability, a key advantage of corporations, and no double taxation, a key advantage of sole proprietorship and partnerships. LLCs are not limited to small businesses. Companies such as Crayola, Domino's Pizza, and Ritz-Carlton Hotel are operating under the limited liability form organization. An LLC member might be held personally liable for the debts of his or her company. A business owner can be held personally liable if he or she personally guarantees a business debt or bank loan which the company fails to pay employment taxes to the government, engages in fraudulent or illegal behavior that harms the company or someone else, does not treat the company as a separate legal entity, for example, uses company assets for personal use. Now, the benefits are that you, as the business owner, you have limited liability and you're shielded from personal liability for business debts and obligations. Now, when it comes to taxation, profits and losses are passed through to the owners for individual taxation. Flexibility within LLC, it offers flexibility in management structure, allowing for single member or multiple member ownership. And administrative complexity. LLCs typically require more paperwork and formalities than a sole proprietorship. But in all, with a limited liability company, you're not responsible if you get sued. They won't go after your assets. They will only go after the business assets. Mergers and acquisitions, also known as M&A. A merger occurs when two companies combine to form a new company. In this process, both companies cease to exist independently and join forces to create a single, larger company. Mergers are often seen as a strategy to achieve synergies, where the combined company benefits from greater market share, reduced cost, or increase efficiency. There are three different types of mergers. The first one is the horizontal merger. This occurs between companies that operate in the same industry and often direct competitors. For example, Disney and 21st Century Fox. They merge and this merger increased Disney's customer base and reduced competition in the entertainment industry. Disney's goal was to grow its content and entertainment products, increase its streaming offerings, and expand internationally. The second one is vertical merger. This happens between companies operating at different stages of the production process, such as manufacturing merging with a supplier. An example of this was eBay and PayPal. In 2002, eBay acquired PayPal to make it easier for online users to transfer money, which helped both companies expand their networks and reduce operation costs. However, in 2015, both companies became independent again. The third one is conglomerate merger. This involves companies from unrelated industries merging to diversify their business operations. Example of this is Amazon and Whole Foods in 2017. Amazon acquired Whole Foods to enter the grocery industry and leverage Whole Foods' physical retail presence to complement its online platform. An acquisition is when one company purchases another and takes control of its operation assets and liabilities. Unlike a merger and an acquisition, the acquired company does not cease to exist. It becomes a part of it or is integrated into the purchasing company. The acquiring company remains intact, and the acquired company might either continue to operate in it under its existing brand or be rebranded. It's important to keep in mind that acquisitions can be either friendly or hostile. So friendly when it is when the acquisition is agreed upon by both companies and it is mutually beneficial for both. It can be seen as hostile when the acquiring company takes over the target company without the agreement of its management, often buying up a majority of its shares. An example of an acquisition is in 2012, Facebook purchased Instagram. The purpose of mergers and acquisitions for expansion in market share, enter new markets, or expand geographically. Another reason can be to reduce costs through economies of scale, streamline operations, or combine resources. It can also be to increase competitiveness, which can enhance competitive position and gain an edge over rivals. And lastly, it could also be to obtain access to current technology or talent that that company may have, such as intellectual property or specialized skills. Okay, that's all for today's video. Thank you for watching.